Loan terminology can be somewhat confusing because we really don't encounter it that often. Maybe once every few years if we're buying a car or purchasing a home or doing anything that requires any kind of contractual obligation for a loan. What I would like to do in this video is really just cover some basic terminology I would like you to go away with as far as understanding loans and loan structures that you might encounter in the real world. So let's take a look at some of that information here. I'm going to remove my picture altogether here, and we're just going to go through some of these basic definitions. Now, the first one that obviously you probably have heard of a million times is rate or interest rate. That's obviously the cost of the loan, how much it's going to cost you to do the loan, how much the lender is going to charge you to do that loan. And I'm going to show you some illustrations about interest rate that I think are pretty powerful. But if you think about it, and I will say this, I will come from the perspective as both a consumer and once as a former banker, that this is an exchange. You need to buy something. Let's say it's a car, for example. That's probably the most common example. You want to buy that car and you want that car now. Well, you got a couple of choices. One, you could have saved the money up for the car and paid cash, which sometimes can be very difficult in coming up with $30,000 or more in most cases. It takes a lot of years of planning in order to amass that kind of cash for most folks. So what do most of us do? We get a loan. Now, we go to a bank or a lender, whether it's at the car dealership or through your local bank or credit union. You are entering a relationship with that lender. You want something, you want the convenience of having that cash now so you can have that purchase now. And the lender is willing to do that to give you the money based on some criteria. But it's an exchange. It is a business exchange. And obviously, they want paid for their services. And the payment they receive for those services are primarily in the form of the interest rates to which they charge you. So sometimes I would be talking to customers, and they would feel like it's almost a right that they would be given money from another entity to buy something, and it's really not. Again, it is a mutual benefit that both the lender and the lendee go in together with, and that cost of doing that business is for the lender is they want some payment back for giving you that 30 or 35,000 or $40,000 for the car, that cash money right now. And what you get is you get the car right now, and you agree to make payments. So that's interest rate. It's really the cost of primarily, and we'll talk about some more things I want you to go away with, but the cost of that loan. All right, now we're going to get into something called annual percentage rate. Now, this is something as a consumer I want you to be very aware of, because I will pull the curtain back here on the lending industry. There are some games that are played, if you will. So those games are usually in the terms of fees, which we'll talk about as well. But what annual percentage rate does, it is primarily driven by the interest rate, but the two are different. The annual percentage rate takes into account many other factors that are involved in the cost of that loan. So actually, let's go ahead. I'm going to jump down and talk about fees right down here for a moment. So let's say, for example, you're going to buy a car, and you can either get your financing done through the dealership, or you can get your financing done you can go out to the internet or go to your local bank or go to local banks and shop for that rate. Let's say Bank A says, great, we got a great interest rate for you. It's 3.25% for 60 months. Sounds great. That's Bank A. Bank C has 3.75 interest rate. So let's say 3.25, and then the 3.75. Well, you're like, hey, that's great. I'm going to go with 3.25. But you go in to get your loan to sign the paperwork, and they say, oh, by the way, we have a fee. The fee is $1,000. Well, that comes to a shock. The other bank had no fee. So when you think about the whole cost for you, it's the fees involved as well. You have to add those on when you're comparing loans. So if there are any other fees involved, especially something maybe called a loan fee or origination fee, what the annual percentage rate does is it takes into account some, not all, but some of those extra fees in there. So you as a consumer then can compare apples to apples and oranges to oranges, because I will guarantee each bank will have its own fee structure. It may be zero, it may be $500, it may be $20. I don't know. It could be all different things, but it will be different. This allows you as a consumer, by comparing that annual percentage rate, that will help you again compare apples to apples and oranges to oranges. All right, so that's annual percentage rate and fees. I'm going to again ask those questions when you go in for the loan. What other fees are involved here? Because they'll sneak those in on you. And I will say, um, as again pulling the curtain back on the loan industry. I was a loan originator. I was a loan underwriter. I could meet a client and approve my own loans. Um, so I will. I guess I have a pretty good experience with this. The uh, and I'll pick on the car situation in general too. Um, it does make it to your advantage to, I would say, shop at least your local bank where you have a local relationship with your checking and savings. Go in there and say, hey, I'm getting ready to buy a car. And they'll ask you, well, what kind of car are you thinking about? And they might get you pre-approved for X amount. And we'll talk about collateral here in just a moment, but they'll get you kind of generally approved for X amount. And you can kind of know the terms and interest rates going right into the dealership. The dealership is going to want to push you in general to their F&I guy, to their finance guy. They're going to push you back to that finance room where the guy's in the little room and he's going to try to get you to do financing through the dealership. Dealerships will have many, many, many dozens of banks that they can choose from. And they will route, we call it paper, they will route that paper to whatever bank is paying them the most money to do that loan. Now, it could work out just great in your favor. In many cases, it has actually been to my benefit. I have gone into the dealership with my pre-approved, my secret rate. I know I got my deal cut, and I say, "This is my deal. I got it." And oh, guess what? They would find a better interest rate, better terms than what my local bank would do. Almost always could always kind of beat it. Or they might even go back to my local bank and then negotiate something even lower because there's all this volume discounts and all kinds of things, especially with auto dealerships. So, long story short, as I kind of digress here, but um, please go in with when you're buying a car. Many consumers just they take whatever the dealership gives them because they don't care. And when you're buying a car, you tend to focus on payment. You have that payment in mind. And they will play with the term of the loan, the length of the loan, to get you to your payment. But as I'll show here in amortization, that is not necessarily in your best interest. So go forearmed with information. I'm not saying that the dealership can't get you some great deals. I have last 3, 4 cars I have actually financed through dealerships, um, because again they could shop 24 banks at once and they know where to do it. But again, they're going to push usually that their paper. They're going to push that loan into whatever's giving them kickbacks, if you will, that particular month. So it may not be in your best interest. So go forearmed with information. All right. So I digress there on the auto loans, but hopefully that was helpful. All right, so use the annual percentage rate to compare your loan products. It's the best way to compare loan products. Points. Here's another thing, and then we'll talk more about points when we get to mortgages. That's almost an exclusive a term used for mortgages. Mortgage is just a loan. It's a loan for a house. Um, but points are a way to lower your interest rate. It's basically prepaid interest rate. So you may get an offer like this. Well, you can get this loan at 4% with 0 points, or you can get this loan at 3.5 with 1 point. And that, again, you're basically just paying up front. A point is a percentage of the principal amount that you pay up front. So it's basically front-loaded interest rate is what it is. But it can lower your monthly payment, if you will, if that's a target for you as well. But just know that points are, again, a really a form of front-loaded interest rates. Okay, so there you go. There's points. Term of the loan. Down on this definition here. Term basically means what is the general length of the loan. So when we say term, for most automobiles, you might be looking at 60 months. You might be at 72 months. That's a little long at 72 months. But sometimes those dealerships will, you won't even know. I mean, if you don't ask the question, you'll get, oh, so they'll say, well, what do you want your payment to be? Oh, I want it to be $350 a month. Sure enough, they're going to come back with a loan package at $350 a month. They're going to play with the term of the loan, and the interest rate, again, could be much higher than normal market rates because you're just focused on the payment amount. But the term is really the length of the loan. And again, for mortgages, you might have 15 or 30-year mortgages. Automobiles tend to hover around, the 5-year rate, 5-year term. Uh, Fees. All right, we talked about fees. Again, be very cautious of those. Let's really look at it when you're looking at the entire picture of that loan that you're getting. Principal amount. This term is really the amount to which you are being given. Now, for a car, it's the price that you've negotiated with the dealership, or it's the price you're paying for the home, or whatever the item may be. You may be getting a loan, just a cash loan. It's the amount of cash that you're given. So it is again the amount of the loan. Principal, the same thing. Amortization. Now, this is probably the hardest concept for students to get a hold of, and anybody who really doesn't deal with finances on a regular basis. And I'm going to show you a calculator here. Hopefully, that will help um, illustrate amortization. But the amortization is basically a table. It is a table expressed with both the interest and principal for each one of your payments throughout the term of the loan. And you probably have heard this in the radio and TV and just all over the media and just all over places about how absolutely high the amount of interest that you would pay, especially on a mortgage, which is one of these very long-term loans, these 15, 30-year loans, the amount of interest, the thing you hear, you actually pay more than interest than you borrowed. Well, in some cases, yes, that's true, especially on those very long-term loans. So let's take a look for a moment. So we're going to stop at amortization, and I'm going to show you a nice little calculator. There's a ton of them out there on the internet, but here's one that we've used for some other classes. And this, we'll talk about that page in just a moment. But here's the calculator. This is at calculatorstuff.com, a nice little simple amortization calculator. And you can plug in the dollar amount, you can plug in your interest rate, the start of your loan, and the term. So you can basically kind of figure out what your payments would be. It'd be pretty accurate in here. Doesn't have a category for fees, but you're basically financing those fees. So if a bank is charging you $1,000, which is that's a way out of that's kind of an extreme example. But let's say a bank is charging you a $100 loan fee. They're just going to lump it onto the loan amount. So you're actually financing that $100, over the period of a loan. So that's not good either. So, or at least be aware of it. That's the only thing. And then you can make an informed choice. That's what this is all about. You making an informed choice that benefits, that meets your goals. Okay, so with this amortization calculator, I've plugged in $100,000 in here. let's make this more like a mortgage. I'm going to make this. Let's say you bought your first starter home, and you're doing that 30-year mortgage. You got that $100,000 home. Uh, Interest rate at 5%. I haven't checked mortgage rates out, but that's kind of a good ballpark, I guess. I think right now. I will say about interest rates. So right now, over the past, I would say 5, 6 years, interest rates are at historical lows. I mean, this is a very interesting era that we're in interest rates. So money is actually very cheap to get because the interest rates are low. So my word of caution to you about interest rates is that this will not last forever. It can't. There will be some rebound. And when I talk to my parents, I mean, there was a point back in the late 70s and early 80s, and of course, I was in junior high or just starting in high school at that point, and I didn't care about interest rates. But interest rates were double digit, even on mortgages were double digit, and that was a very high period. We have not seen that in decades, and hopefully that will not come back because inflation has been kept somewhat in check, but they are going to creep back up again, I'm sure. So keep that in mind too as you kind of think about things. I always encourage if you're kind of on the edge about home ownership, probably if you can do it now, you'll probably be looking back 10 years from now going, geez, I got a great interest rate. So, all right, but let's use our amortization calculator. We're going to use that starter home, $100,000 and 30 years and 5%. And we'll just start it off on the at the end of the year. And we're going to hit calculate. It's going to come up with our payment. Okay, so our monthly payment is $536.82. And again, we'll talk more about mortgages. There could be various insurance items escrowed in a mortgage. We'll talk about escrow later. But this is really just your principal and your interest that you're paying the bank back for that loan of $100,000 that you have over 30 years, kind of a standard term for a loan. All right, so what are your total payments? Your total payments are $193,000 and some change. Remember your original dollar amount that you paid for the home? That was $100,000. So yes, you are almost paying as much in interest as you did for the loan itself, for the principal amount of the loan itself that you received. That's just the way it works. It doesn't mean the bank is evil. It's just the way it works. Um, Especially you see this even more exaggerated the longer the term of the loan is. You'll see that interest amount creep up, and the interest rate. Again, we're using a pretty reasonable interest rate at 5%. So imagine if it was around 7, which might be more normal in 5 or 7 years from now. You will be paying more in interest than you are in the actual amount given. Again, remember that I talked about at the beginning of the lecture. It's an exchange. You want that house now. You could save money. You could save money over 15 years and pay cash for it maybe, but you want it now. So, and home ownership is the good kind of loans. So I'm not going to bash that too much, but that's really just the cost of doing business with the bank. So here's the interesting thing about amortization, and we'll kind of look at what I like about this calculator is it shows in summary form the interest paid and the principal balance paid back. So as you notice in the first years of the loan that you could see the interest paid is 400 and or $4,900, and the principal amount you've only reduced your principal by $1,475 in the first year of the loan. As you go through time, that increases, where you are paying more in principal versus what you are paying in interest as you get closer to the final date of that loan. All right, so there's a little bit kind of graphically how it looks. Here's where we can look at the amortization schedule, and I'm going to look at the monthly actual breakdown each payment. So let's say you got that new home, you're all excited, you're living in it, and nope, here comes time to pay the first payment on your loan. So the first payment is that $536. It's, if you see here, it's that every month, right? Doesn't change. Doesn't change because you have a fixed rate loan, not variable rate. So you have a fixed rate loan. And that dollar amount doesn't change. That's going to stay the same for 30 years. Okay. But notice that first payment, $416 is all interest. You're only reducing that $100,000 that you had by $120. That's a payment one. And we can scroll through the years here. We'll go way, way down, 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 down. Go to about the middle here. So we're getting the middle. It's now January 2034. You're still paying that $536 a month, but now you are almost split equally between interest and principal. You're starting to pay more down on that principal as you get closer to the maturity date of that loan. And it has to do with something called the time value of money, which we're not going to get into with this course, but the foundation of the time value of money basically makes all of these payments equal when you take into the concept of time. It's like, ask yourself, hey, I'll give you $10 today, or would you like $10 in 2 years from now? Well, you say, I want $10 today. So that's basically the general concept of time value of money, and you can use that forward or backward in time. So, but it's a little, but just know it's the math. It's not the evil bank. It's the math of how it all works. And then let's get down towards the very end of the loan, and let's see how those principal payments are. So you're almost done. And in this case, you're only paying $11.05 in interest, and almost everything's going towards reducing that final principal balance until you get to zero and you own the home free and clear. So that's when you hear amortization, it's really this process of creating this table where it includes both the interest and principal reduction for each of your payments that you have throughout the term. Now, again, we can adjust this. We could do let's do a car loan. Let's do a typical car loan. Let's see. Oh, let's say you got a $35,000 car, and you're going to do 5 years. And the dealership's got you a great deal. We'll stick with that 5%. You should probably actually get lower than that, but let's go with that. And let's calculate that. Our monthly payment is $660 a month on that, and you can see our total interest. Again, a shorter term loan here, and our principal amount is reduced, but we look at it from a percentage value, okay? Because we're actually, let's go ahead and click OK on that. We'll go back. I'll show you that credit report monitoring service in just a moment. But the percentage of what you're paying. So remember, you got $35,000 was your principal amount, and you're paying the bank basically, in essence, $4,600 for the immediate benefit of having that car and getting that $35,000. So it's not as drastic as when we looked at the mortgage, where you were almost paying as much as the loan amount in interest. Again, we're using a shorter term here. On this loan. That can be very powerful. So the rule of thumb is try to get the term as short as possible for you. Now, I will discuss a strategy here in just a second. So let's go ahead and we'll remove this now. It's a little bit about amortization. Remember, that was at calculatorstuff.com if you want to play with that. Okay, so there's amortization. Now, prepayment penalty. Here's something I want you to always ask about, okay? Now, I have noticed a trend recently where this has been, at least what I've anecdotally noticed, is that this has been somewhat done away with, which is good. But there is some loans out there may have a prepayment penalty, which means, let's say you buy that car, that $35,000 car, and it's a 5-year loan. And I don't know, you get a windfall of cash. Something happens, you get a bunch of cash, and you want to pay it off early. You want to pay it off in year 2. Well, the bank may say that's great, but we have a prepayment penalty if you pay it off before X number of months. It might be the full term of the loan. It might be within the first 3 years. It might be something of some combination thereof. But they might say like you have to pay at least 6 months interest on top of the outstanding principal balance due. Okay, that principal balance due. Um, so be aware of that. Ask about that. Now, from the bank's perspective, I'll give you their perspective. In some cases, that could be fair. So let's say you had no loan fees and you had really, very simple lending, fees for the customer. So you do this loan for somebody and you put in all the time. It does take time. There's a lot of people behind the scenes recording loans and making sure it's administered correctly, and you have to pay the loan officer his wages or her wages. So people are involved with this process behind the scenes. And let's say you pay it off in 6 months, and there was no loan payment, there was no prepayment penalty on that. Um, and the bank only received a very small amount in interest really for their trouble. That's kind of the thing. Did they receive enough in interest payments for their trouble to do the loan? So just be aware of that. Again, the good news is I have not seen this show up a lot in some of the loans that I've looked at on the consumer side. So I think that's kind of being done away with. But it is something to ask about on prepayment penalty. Now, I'm going to go off script here just a little bit too and talk really about loan prepayment and some strategies to reduce those interest rates in there. There is something called a principal only payment. So, and almost all loans will allow you to do this, but most people don't know this. So here's an insider trick for you, which I use quite frequently. The insider trick is this. So let's say most of us don't get a huge lump sum windfall of cash where we can just, I'll pick on the car or the mortgage that we could pay it all off. But some of us might receive, let's say you got a bonus from work, and let's say it's $1,000, and you're going to use 250 of it. You might say, and you're going to save some of it, right? And then some of it you're going to use for your debt reduction. So you might say, all right, I'm going to use $250 of my bonus to pay off my car, and you just mail in the check, and you don't say anything else. You just mail the check in. You write your loan number, say, please, loan, prior to loan. They will apply that payment typically as an amortized payment. Remember that schedule I showed you where some interest rate and some principal. They will fit it into that schedule unless you tell them principal only payment. And that's the magic word. So make sure you write that a big note, on their principal only payment. Then they will apply that directly off of principal, and that's what you want to do. And that can really accelerate the payment, really accelerate your loan uh, repayment just by doing those every now and then. We did that on our mortgage at one point, and then we have also done that on vehicles, and that it does help when you have that extra little cash. So there you go. Remember that that principal only payment. Otherwise, they'll just stick it in that amortization table, and they'll stick it in the amortization table. Plus, you'll still have your normal monthly payment due. So it's kind of like a double whammy. You think, oh, well, I'm just paid ahead. Not necessarily. So be very clear about it. If you are making any extra payments, my recommendation is um, don't make extra payments on your normal monthly payments. Maintain that consistency. Maintain that monthly payment. But if you do make extra payments, make sure they're applied towards principal. Okay, so we've talked about amortization. We've talked about prepayment penalty. Now, the whole term that we're going to use for this agreement that you might hear used is promissory note. That's the piece of paper you sign. That piece of paper is going to spell out the term of the loan. It's going to spell out the fees will be on there, your interest rate will be on there, and the annual percentage rate will be on there as well. So it's all going to be on there as a thing that you sign your life away on. So that is called a promissory note. Some people just call it a note. I'd have customers come in the bank and say, I want to make a payment on my note. Uh, that's their loan. That's their loan agreement. So that's what that is. Now, collateral. What is collateral? Collateral is what the bank may take as an asset to secure the loan, to somewhat guarantee the loan. Now, the one that we're most familiar with, automobiles. Okay, so or the mortgage, the house. So the bank actually, in the case of a vehicle, they actually have a lien on that vehicle. Okay, so they could, if you default for any reason, the repo man gets called and they take your car away. If for some reason you default on your mortgage, well, they'll take your home away as well. So it's that collateral that's being used. Now, not all loans require collateral. You could have what's called a signature loan, and it's there's no collateral involved, and you are just given the cash, and maybe you're using it to buy a car or go on vacation or whatever you might do with it. There are signature loans out there that require no collateral. All right, so let's talk a little bit as I'm bringing up that collateral discussion um, and interest rates. So sometimes, again, the bank is taking a risk on you. So what we have, we like to call it the three C's of credit. And sometimes there's the four C's or five C's, but I'll pick on the three C's. And the fourth C might be collateral, that collateral that we use, the automobile or the home that we use. It might be something different. I mean, I've used boats. You can use all kinds of things as long as you can establish a clear value on it. Just a little aside, the hardest ones I've ever done were classic cars because it was very hard to assign a value to to a 19 1964 and a half Mustang. It could be a pile of rusted junk, or it could be worth $72,000. It was very hard to establish value on some of those things. So banks generally like things that are very easy to establish value, like new automobiles or even, you know, uh, used, not, you know, 50-year-old vehicles, but used vehicles, and homes. Homes are very easy to establish values on. So that's kind of the collateral piece. Now, the three C's of credit are character, capacity, and capital. So character really is for you. You are the person seeking. What is your character? And that character is really based on your payment history. Have you paid your loans off in the past? Or did you default? Or did you go into some sort of repayment agreement with the credit card company? That will show up. That shows that you had some hiccups, maybe, or even worse, bankruptcy. So that shows your I guess your character, that history of payment is usually what that means. Capacity. Do you have the ability? You might have great character. You might have an 805 credit score, okay? But do you have the capacity to make a $600 car payment? Um, that again, credit score. If you don't have the capacity to make a $600 car payment, because maybe you make $23,000 a year, and plus you got to pay rent, uh, they're going to question whether you can actually make those payments, and they'll use something called a debt ratio. How much debt? And that's also obligation, your rent and mortgage and living expenses, etc., and the cash left over. So do you have the capacity to make your loan payments? And then capital really refers to other assets that you may own. So you may be very capital rich. Maybe you have, a lot of real estate holdings or huge retirement accounts. And these things can kind of be looked at together. Maybe great character, solid capital, but maybe they're on kind of a retiree income. So you can kind of look at these things. A lender can kind of look at these things and make a decision on a loan. And sometimes the capital. I mean, if you look at someone who's extremely capital wealthy, and you know that potentially if something could happen, that they could always get into that capital. All right, so those are the three C's of credit, and there are things that you want to be aware of as you are building that. And you do want to, I am not anti-loan. Loans are very helpful. I quite frankly have a car loan. Now I'm trying to make those principal only payments when I can, but it is something that is a tool for us to use and to use knowledgeably. That's the critical part. All right, so let's talk about credit score. A lot of news, a lot of buzz about credit score. So there is somewhat, and over here on the side here, you see the big three. Okay, Experian, TransUnion, and Equifax. What are these? They're basically data aggregators. Okay, they people that you do loans with, or credit cards, or store cards, or almost anything credit related, um, and even non-credit related, I would say, let's say even some healthcare expenses that maybe you defaulted on, um, will report to credit agencies. Okay, they'll automatically report this information to them. And then lenders will go to one or all three of them and pull the dreaded credit report. And the credit report, trust me, shows everything. I mean, it's amazing and spooky and scary how far they go back and everything that they know. So they're pretty gosh darn accurate, but with a caveat. Sometimes they're not perfect. So we're going to talk about watching your credit, looking for potential erroneous information that could be on there. But in general, I would say in my history that they are very accurate and do collect a pretty good information on customers. So, and you'll be able to pull your own here, and I'm going to show you how to do that for free. So, and the credit score is somewhat proprietary for each one of these companies. They have their own way of coming up with a number. I know all of us hate to be given a number. It's a grade, right? You'll be giving a grade on your credit. But and they all have their kind of own proprietary formulas, but it's somewhat all the same. There's good scores and then there's bad scores. And I will say in general, they're pretty accurate. They are pretty good determinant of credit. At some points in my career, the bank I worked for, sometimes we would just lend based on score only. I mean, they were that trustworthy. So they are pretty good. Now, are we defined by our credit score? No, we're not. There are other conversations that can happen. And I'll tell you, from my experience, the biggest conversation I had with customers was around medical expenses. There would be some major medical thing that would show up on their credit bureau, and it would drive their credit score down. We got to the point where we were not even looking at those. We would discount that negative history when it came to the healthcare. So there are conversations that can be had, but again, you want to have informed conversations with your lender, and that's knowing what is on your credit reports. Um, let's talk a little bit about those scores too. There is somewhat of a mystery about again these companies historically have kind of guarded their formulas, okay, because that's how they make their money. They pride themselves on having the most accurate forecasting information. But there are some things that drive credit scores down that you may not be aware of. So the the first one is um, you think having too many lines of credit, having too many credit cards, even if you have zero balances on your credit cards. Okay, you're thinking I'm great. I pay my credit cards in full, but I got 20 of them. I got 20 credit cards in my purse, but no balances. actually that can lower your credit score. Why? Why would that? Think about it from the bank's perspective. You come in, you want to buy a car, great. We approve you a car, but your credit score isn't great. You're like, what do you mean? I pay everything on time. Well, it's not as great as it should be because this is what could happen. You could go out. I give you this loan for the car. You could go out right now and max out every one of those credit cards. You could have a midlife crisis and max out every one of those credit cards and have no possible way of paying it all back. So, having too many lines of credit, credit cards or loans, can actually work against you. So, there is kind of a sweet spot. And you kind of want to, by monitoring your credit, kind of find that sweet spot. I can say just again, I'm just going to give you my own personal perspective. I would say around 2 or 3 lines. I'm down to 2 lines of credit cards, and that's it. And my credit score is pretty good. So I think I've kind of found that sweet spot. But there was a time where I was like, oh yeah, there's a great credit card. I had 5 or 6 credit cards, no balances on them, but it's like it's kind of fun collecting them, especially in my early 30s. It was kind of fun, hey, I got great credit. But then I started to notice that it actually would count against me, so I started closing those lines out. Plus the added risk just from an identity fraud issue by having additional lines of credit. If someone got a hold of that credit card, I got 5 credit cards and that number got exposed, and all of a sudden that's getting, I'm not making the charges, but someone else is, and you got to go through all that mess and nightmare. So it also reduces your own personal exposure to any kind of identity fraud or erroneous charges happening on your lines. So find that sweet spot for you, but don't, if every you go into Target or you go into Walmart or whatever, and they're like pushing their credit cards. Like, no, I got enough. I don't need another credit card. So be careful about that. Another determinant on credit is obviously having credit and having paid it back. So I would have customers come in that were cash only customers all of their life. Rich farmers, and some of them are rich, paid cash for everything. I'd pull up their credit bureau, zip, nothing. But yet they got 1,000 acres. Okay, so but they needed a loan for a particular whatever at this one point in time in their life. So you do want to establish some credit. You want to establish a payment history and make your payments obviously on time, because trust me, the credit bureaus do that information is reported. Make those payments on time. So do establish some credit. Um, even if you might think I'm just starting out and I don't necessarily need a loan. Sometimes you might want to, I'll get a 24-month loan and just pay it back and start establishing my credit history. It may be worth it for you. Again, make an informed choice before you do that. But that is sometimes a strategy in order to start building your credit number, your credit score. So when you do need to do the good loans that we've talked about, for example, and student loans are a whole different animal because of the traditionally the federal guarantees on those, but a mortgage, okay? You're trying to build that credit score to get a really good rate on your mortgage. Strategies like that may work. Using your credit cards every month and paying them off in full is a strategy that can help. That can help build your credit score. So remember that. In the case of the rich farmers that would come in, we would use the capacity and the capital, because the character, even though they had one character, was based on payment history and we had none, but we were able to qualify them, based on some other areas, as long as we were able to document that. So it doesn't mean that cash only people didn't get loans, but it made it a lot harder because they had no credit score. So, those are some basic strategies with your credit score. Here was another one that people, uninformed consumers, that they would go into, and you hear it on the news even today. Call XYZ company and we'll negotiate with your creditors to lower your payments today. True, they can do that. Go in there and negotiate with those creditors to lower your credit card payments. But trust me, that information is going to get reported to the credit bureau, because you are now basically saying you're saying to the banks, I'm in trouble and my capacity is limited. Okay, remember the three C's? My capacity is now limited in paying off my debt and obligations. The banks are going ding, 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 ding. This person's on the verge of bankruptcy. If they go bankrupt, I get nothing, nothing typically. Okay, and that's that's a lose for the bank if you go bankruptcy. So I mean, you could say, oh, they can repossess the car or whatever, but even when a repossession happens, it's a big loss for the bank. It's the last thing we want to do is take somebody's car or take somebody's house. So they're like, well, how can we make this work? All right, so they'll maybe they'll negotiate, they'll lower the interest rates, they'll stretch your term out. Remember the term we talked about? Maybe they'll stretch that out. They'll work with it, but trust me, you're going to be a red flag now from that point. Your capacity has been signaled as diminished. So be careful when you do that. I had people who said, "Oh, I thought it was the greatest thing. They lowered my payments. It was great. I didn't need it, but yeah, why not pay less? Okay, did you realize that it just destroyed your credit score?" So be very, very, very cautious with that. Now, I think some consumer practices and protections have come in against that kind of situation. Um, but it's still out there. I hear the ads all the time. So please do be careful. If it is something you absolutely need to do, remember that's basically the you're trying to do everything you can to avoid bankruptcy at that point. That's really where I think you need to be before you would even enlist the help of one of these agencies. And again, I'd be very, very careful about working with them and what do they charge because they don't do it for free necessarily. So do be careful there. All right, so there are some hints on credit score, how to establish your credit score and preserve that credit score. Let's talk real quickly about how to get your free credit score. So the federal government stepped in, oh, quite a few years ago and said, hey, they said to the big three, Experian, TransUnion, Equifax, you got to give people a free credit report. They got to be able to see this information. And you'll hear again on TV, radio, Facebook, wherever, you'll hear about companies that offer free credit reports. And many of them do, but there's also some other catch or hook or other thing that they're wanting out of that. Now, how do they do it? Well, from what I remember, for us to pull a credit report on somebody, I think it might have been around 49 cents. It wasn't a lot of money. So they might be, again, just making this up. They might be charging, 50 cents per credit report that they pull on you, and they're just giving that away to you, even though they might be paying for it. So they're giving it free to you. It may not be free for them. For that $2 to $3 that they're spending to aggregate your three credit reports, they're getting something out of it. They want to usually sell you something or get you connected with something. So be careful about that because there is only one authorized entity by federal law to that was created by this regulation for your credit reports, and that is this web address here, annualcreditreport.com. That is kind of the authorized one. So that is what I would say if you want to have some fun and you want to look at your credit score. Let's pull this up real quick. And let's see if we can get into there. I think I've been timed out on it, so hold on one second. Um, oh, no, we're not. I haven't timed out yet. Okay, so yeah, so here it goes. And it's as you can see, the only source for your free credit reports authorized by federal law. So this is again, the website that I have used, and it has been very, very reputable on that with no hidden catches or anything that I've experienced with here over the years. So and there was a lot of good information about scoring and what it should look like. If you should find anything on your credit report that's not accurate, how to petition the credit reporting agencies to work to get that information removed. So it is good to give yourself that credit report checkup. There's nothing like knowing you have a 805 credit score and you're walking into the bank and knowing you're going to get the best credit rate they've got. And that gives you a sense of control information about making good choices with what we're going to do with lending. All right, so that covers some lending basics that I wanted to give you. I want you to be forearmed with information. Again, I'm not an anti-loan person. They definitely can serve a purpose, but I want you to make an informed choice as you look at various loan options for whatever you may be doing throughout your kind of your financial life. All right, thanks for watching.